Fiscal year 2024. The United States government paid $1.1 trillion in interest on the national debt. Not on roads, not on schools, not on healthcare or defense, just interest. To put that in perspective, $1.1 trillion is more than the entire defense budget. It's more than Medicare spending. The United States is now spending more money paying interest to bondholders than it spends on the entire military. And here's the terrifying part. That number is accelerating. In 2020, interest payments were $520 billion. In 4 years, they've more than doubled. By 2026, projections show $1.4 trillion. By 2030, possibly $1.8 trillion. Every dollar spent on interest is a dollar that can't be spent on anything else. Not infrastructure, not research, not education, just servicing past debt. So here's the question. What happens when the debt machine that funded American global dominance for 50 years stops working? Because that's not a future scenario. That's what's happening right now in 2025. And Russia and China aren't just watching. They're actively accelerating the breakdown. How the machine worked after World War II, the United States built the most elegant system for financing government spending ever devised. The US government could borrow essentially unlimited amounts at very low interest rates. Why? Because the dollar was the world's reserve currency. Every country needed dollars for trade, especially for buying oil, so every country held dollar reserves. And what do you do with dollar reserves? You invest them in US Treasury bonds, the safest asset in the world. This created perpetual demand for US government debt. No matter how much America borrowed, there were always buyers, foreign governments, central banks, investors. This demand kept interest rates low. Low rates meant cheap borrowing. Cheap borrowing meant America could run deficits forever without facing a crisis. This is exorbitant privilege. The ability to borrow in your own currency, print that currency if needed, run deficits that would destroy any other country, and face no immediate consequences. For 50 years, this machine hummed along perfectly. America borrowed, the world bought the debt, interest rates stayed low, it was a perpetual money machine. But watch what's happening now. The machine is breaking. The first crack, foreign demand collapsing. In 2013, foreign holders owned about $6 trillion in US Treasury securities. By 2025, that's fallen to roughly $4.8 trillion. That's a $1.2 trillion decline. China alone has reduced Treasury holdings from a peak of $1.3 trillion to under $800 billion. Japan has reduced holdings. Saudi Arabia has cut its holdings by over 40% since 2020. Now you might think someone else will buy the debt. Partially true. Domestic buyers have picked up some slack. But here's the problem. Domestic buyers demand higher interest rates. Foreign buyers weren't just buying for investment returns. They needed dollar reserves for trade. It was structural demand. They had to buy regardless of interest rate. Domestic buyers are different. They compare treasury yields to other investments. If stocks offer better returns, they buy stocks. To attract domestic buyers, yields have to be competitive, which means higher. And higher interest rates mean the government pays more to borrow, which means larger deficits, which means more borrowing. It's a vicious cycle. The $300 billion turning point. Let me tell you what happened in February 2022 when the United States froze $300 billion of Russian central bank reserves. This was supposed to be the ultimate economic weapon. Russia's savings vanished overnight. The message to the world was clear. Defy us and we can take your money. But the message received was different. Every finance minister in every country thought, if they can freeze Russian reserves over Ukraine, they could freeze ours over any dispute. Our dollar savings aren't actually ours. They're hostage to American foreign policy. China, holding over $3 trillion in foreign reserves, largely in dollars, had an immediate reaction. They began systematically reducing dollar exposure. Not overnight, not dramatically, but steadily, deliberately, irreversibly. Chinese treasury holdings have fallen by over $400 billion since 2022. But it's not just about selling treasuries. China is restructuring its entire economic relationship with the world to reduce dollar necessity. The trade currency shift. China is the world's largest importer. They buy oil, gas, food, raw materials. Traditionally, all these purchases were in dollars. But watch what's happening now. Russian oil and gas to China, paid in yuan. Saudi oil to China, increasingly yuan. Brazilian soybeans, Australian iron ore, Chilean copper. More and more settling in yuan. Each transaction that shifts from dollars to yuan means China needs fewer dollar reserves. Fewer reserves means less need to buy treasuries. Russia is doing the same from the seller's side. They can't use dollars because of sanctions, so they've restructured everything. Oil to India, paid in rupees, gas to China, yuan, weapons, local currencies or barter. Russia pioneered a non-dollar trading system, and now they're helping other countries adopt it. Because every country that trades outside the dollar system doesn't need dollar reserves, doesn't buy treasuries, and weakens America's debt machine. The numbers don't lie. In 2020, foreign buyers purchased about 55% of newly issued treasury debt. By 2025, that's down to roughly 35%. The difference has to be made up by domestic buyers and the Federal Reserve, essentially printing money to buy bonds. But the Fed can't do this indefinitely without triggering inflation, and domestic buyers won't buy unlimited quantities without demanding higher yields. The average interest rate on U.S. government debt has risen from about 1.5% in 2020 to over 3% in 2025. Apply that to $36 trillion in debt. Every percentage point increase adds roughly $360 billion to annual interest costs. This is why interest payments exploded, not just because debt grew, but because the interest rate on that debt doubled. The debt spiral, here's the nightmare. This is self-reinforcing. As foreign buyers withdraw, rates rise. As rates rise, interest costs increase. As interest costs increase, deficits grow. As deficits grow, more debt must be issued. As more debt is issued, fewer foreign buyers are available, so rates must rise further. This is the debt spiral, and America is entering it right now. BRICS Bridge. The BRICS nations are constructing payment systems that bypass the dollar entirely. BRICS Bridge, operational since late 2024, allows member countries to settle trade in their own currencies. No dollars needed, no treasuries needed. By 2025, BRICS Bridge is processing over $200 billion annually in transactions. That's $200 billion that used to require dollars and no longer does. It's growing at 40% per year. In 3 years, it could be $600 billion. In 5 years, over $1 trillion. Each dollar that shifts to alternative systems is a dollar of reduced demand for treasuries. The gold rush central banks globally have been buying gold at the fastest pace since 1967. In 2022, 2023, and 2024, central banks bought over 1,000 tons of gold each year. For decades, central banks were net sellers. Now they're accumulating frantically. Who's buying? China, Russia, Turkey, India. Countries actively working to reduce dollar dependence. They're converting dollar reserves into gold because gold can't be frozen by sanctions. Gold can't be devalued by money printing. Russia has built gold reserves to over 2,300 tons, worth roughly $170 billion. China officially holds about 2,200 tons, though analysts believe the real number could be over 4,000 tons. This represents hundreds of billions that used to be in treasuries and are now in gold. That's permanent demand destruction for U.S. government debt. The petrodollar crumbles. For 50 years, oil was priced exclusively in dollars. This created structural demand for dollars and treasuries. But in 2025, roughly 20 to 25% of global oil trade is settling in non-dollar currencies. Russian oil to China and India in yuan and rupees, Saudi oil to China in yuan, Iranian oil to China in yuan. This represents roughly $600–700 billion annually in oil trade that no longer requires dollar reserves. As the petrodollar system erodes, so does structural demand for treasuries, and this demand is permanently gone. What this means for power. The U.S. federal budget in 2025 is $6.5 trillion. Revenue is $4.9 trillion. The deficit is $1.6 trillion. In 2020, interest payments were 8% of the budget. In 2025, they're over 17%. By 2030, they could be 25%. A quarter of all government spending going purely to interest. That's money that can't be spent on healthcare, education, infrastructure, or defense. This creates impossible choices. Raise taxes substantially, cut spending drastically, or accept larger deficits that push interest costs even higher. None are politically popular. All weaken America's global position. The defense problem. The U.S. defense budget in 2025 is $850 billion, more than the next 10 countries combined. But interest payments are $1.1 trillion. The government pays more in interest than it spends on the entire military. China's defense budget is about $300 to $450 billion. But China isn't paying $1.1 trillion in interest. They're investing in military modernization, technology, infrastructure. The debt machine that was supposed to fund American dominance is now constraining it. The failed auction. In November 2024, the U.S. Treasury held an auction for 30-year bonds. The auction failed to attract enough buyers at the offered rate. The Treasury had to raise the yield mid-auction to attract demand. This is called a failed auction. It's extremely rare for U.S. government debt. The market was sending a message: we're no longer confident in unlimited Treasury demand. You need to pay us more. This is a warning. The debt machine is breaking. What they're doing. Instead, China isn't just selling treasuries. They're investing in real assets, belt and road infrastructure, strategic commodity reserves, gold, technology, domestic development, real things that produce value and can't be frozen by sanctions. Russia learned the same lesson. Their frozen $300 billion taught them that financial assets in Western systems aren't assets, they're hostages. So Russia shifted to gold, domestic infrastructure, strategic stockpiles, relationships with non-Western countries. Every dollar shifted from treasuries to alternatives is a dollar America must find elsewhere at higher rates. The unavoidable future. By 2030, the cost of servicing debt will consume such a large share of government revenue that hard choices become unavoidable. Cut defense significantly, raise taxes dramatically, cut entitlements, or accept inflation by printing money to buy debt which devalues the dollar. None are attractive. All represent significant reductions in American global power. The debt machine that funded American dominance for 50 years is breaking. Russia and China didn't break it through superior economic performance. They broke it by deciding they would no longer participate in funding American debt and by building alternative systems that allow others to make the same choice. The machine worked as long as the world had no choice but to hold dollars and buy treasuries. Now the world has choices, and increasingly they're choosing alternatives. This isn't the end of American power, but it's the end of American financial exceptionalism, the ability to borrow unlimited amounts at minimal cost, the end of running massive deficits without consequences, the end of exorbitant privilege. Without that privilege, American power will need to be funded the way every other country funds its government, through taxes, through actual production, through living within means. For a country that spent 50 years consuming more than it produces, this adjustment will be profound and painful. The debt machine is breaking. Russia and China accelerated the break. The global shift from American financial dominance to multipolar finance is underway. We're living through the transition. Most Americans don't see it yet, but the numbers don't lie. $1.1 trillion in interest, foreign demand collapsing, alternative systems rising, the machine is breaking, and the sound it makes is the sound of American global power being restructured around us.